ultimately they didn't address the root cause of the problem, which is too much debt, particularly in the financial system. But now it's even on the government balance sheets as well. The vast majority of society and all the key actors in our economies are impaired from a debt point of view. But they don't. They just go on the keyboard now and they create trillions and trillions and trillions of euros, dollars, and pounds. And the fundamental reason that gold and silver will do very well in the coming years is that the currencies, the fiat currencies, are going to be devalued.
We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mark O'Byrne, founder of healthwealthgold.com. Thanks for joining me today, Mark.
Pleasure, Tom. Good to be back on with you.
Great to see you and speak with you again here. So you've said before that gold is a barometer of risk. So with all the acute risk in the world today, from the Canadian government seizing people's bank accounts and enacting the Emergency Measures Act, and also the Russia-Ukraine situation, we really haven't seen gold react that much. So do you think that some of these risks were already priced in?
Somewhat, that may be a factor, but I think the bigger factor is the ongoing manipulation in the futures market, as documented by Gov't, the Gold Antitrust Action Committee, and by numerous other analysts, precious metal analysts over the years. And indeed, we had the prosecutions, the SEC, Department of Justice, found JP Morgan guilty of rigging of the precious metals market. So I think that's an ongoing, they got little slaps on the wrists and little fines of 1 week's sort of trading profits. So I think it's more of the same, because in any sort of normally freely traded precious metals market, you would think the surge in inflation that we've seen around the world in recent months, that should have pushed both gold and silver much higher. Gold has begun to react a small bit, but that, and then the other risk that you mentioned, the geopolitical risks. There's a very significant geopolitical risk all around the world, and the latest flashpoint is obviously in the Ukraine, between Russia and the certain EU powers and the US and certain Western powers, and obviously NATO. So I mean, these are real risks and real flashpoints, and I think gold and silver should have moved much higher in recent months, particularly in reaction to the inflation risk. I suppose the mainstream narrative is, well, they haven't gone higher because the Federal Reserve is going to increase interest rates, and there's all the usual chatter that you get from the central bank bottoms themselves and the Federal Reserve and ECB, and they always talk. They always say they've been saying this for 15 years plus, or 20 years plus. So we're going to increase interest rates significantly, and we're going to react. And they don't. We've had ultra loose monetary policy for a long time. And they may increase interest rates by 25 basis points or 50 basis points. But they know as well as we know, if they increase interest rates in any material manner, they will burst the massive debt bubble that they've actually created, this giant Ponzi, and the debt is just astronomical across every strata of society, So they can jaw and they can talk the talk and pretend to increase their interest rates, but they're not really going to do it in any material manner. They can't afford to really. They would crash the economy and crash the markets as well, So and ultimately, even if they do increase interest rates by 1 or 2 or 3%, inflation is running at 5, 6, 7, 8% plus, in most economies around the world. And I think we're in the early. It's not transitory, and for a number of reasons. And I think we're in the early stages of inflation. I think it'll be with us in the medium term and potentially the long term. And ultimately, gold and silver only become vulnerable towards the end of an interest rate tightening cycle, as was seen in the 1970s. So not at the start of an interest rate tightening cycle, it's at the end of the interest rate tightening cycle that precious metals become vulnerable. This was seen very clearly, obviously, in the 1970s. So, and it's only when we have positive real interest rates that gold and silver become vulnerable, and we're far from positive real interest rates now, and I'm not sure it's going to be a long time before we get there.
So, as you point out, the rate hiking cycle is really a driver for higher gold prices in the past. But how do you see gold reacting when they actually start to hike rates? Like upon that first rate hike, do we typically see a new low for gold followed by, a material rise?
I think we do, yeah. I haven't looked at the data in a while, but from recollection, I think in the short term, you tend to see a knee-jerk reaction, and you do tend to see weakness in the short term and sell-offs. And then the media, reports that gold has sold off because of the all-powerful central banks have come to the rescue, and they're sorting out inflation by raising interest rates by 25 basis points or 50 basis points. But generally, quite soon afterwards, in the medium term, within weeks or short months, you tend to see gold having gone higher. And that was seen. There was a great chart and table that I used to produce in our market update. And it looked at the cycle, I think it was from around 2003 to 2008, but don't quote me on that. But basically, they went, I think, roughly from 1% to 4 or 5%. And meanwhile, gold prices went up every single year, So right there, and you've seen this throughout history, there tends to be a correlation with gold and interest rates. And when interest rates are going higher, gold tends to go higher. When interest rates are falling, gold tends to go lower. And that was seen obviously very clearly, again, in the 1970s when interest rates went higher throughout the 1970s, pretty much, and gold went higher throughout the 1970s. So you're right, there could be short-term weakness, and the media is focusing very much on that and justifying the recent weakness of gold and silver because of the chatter of interest rate hikes. But again, I don't think they're as big a factor as the media continuously and certain analysts in bullion banks would suggest they are.
Mm-hmm. Mark, you were saying that you expect to see inflation continue here, but as we think about the real negative rates of return that we are seeing right now, is it possible that we see inflation start to abate because of a recession, or do you expect it to continue at the rate that we have seen over the past year?
I expect it to continue, but there are no guarantees, and I don't have a crystal ball, and nobody does, because we have a variety of risks, a multitude of risks, and indeed very, very significant risks. Arguably, the world is as risky a place as it's been in our lifetimes, and indeed many of your older listeners' lifetimes as well. Arguably, we haven't seen this sort of risk since back, in the Cold War times in the 1950s, 60s, 70s. No, there's a crystal ball, and the level of debt is so huge, and I think the economy is very vulnerable, that you could see a bout of deflation for a period of time. If they did increase interest rates quite significantly, then you could see property markets come under pressure. You could see, demand destruction. Because potentially there's more people unemployed, there's less consumption, and therefore the companies don't have the purchasing power in terms of increasing the prices on their products and their services. So that is a possibility, but I think the central banks are very reluctant to allow that to happen. I think more likely we're going to see inflation and indeed stagflation. So where you get contracting economic growth, you get recessions, and you also get the inflation, because the inflation is primarily coming from the massive increase we're seeing in the value of commodities, in energy, in oil, in natural gas, in the metals, in food prices. I think this is far from transitory. These commodities, and particularly the more finite commodities and natural resources, were very, very undervalued in recent months and years. And now they've gone up very, very significantly. But I think there's as we know, there's very significant supply chain issues. And so I think the inflation story, and I do genuinely think on balance, if forced to choose, I would be leaning more towards inflation and stagflation than deflation. And I think the only deflation we're going to see is not so much in consumer price index indices or purchasing price indices in terms of consumer inflation or wholesale inflation. I think it's more the deflation will probably be in the assets, because obviously they've created this global everything bubble, so the property markets in the big cities around the world are very vulnerable. The stock markets look quite vulnerable, and indeed the bond market is very, very vulnerable, not to mention their fiat currencies, so I think you'll see the deflation in the asset markets rather than in the value of the things that we consume and the things that we need, in particular in terms of food, water, and energy.
Mm-hmm. Mark, when you mentioned the debt levels of some of the countries, you've mentioned before that we typically only think of public debt as mattering, but why should we also take into consideration private debt to really get a picture of let's say the health of the country as well?
Well, yeah, it's so important because that's that gives you a better indication as to the health of the consumer and the health of the companies, the small and medium enterprises in particular, who are the backbones or have been traditionally the backbones of most of our economies, and indeed the corporates and the banks. So in some ways, you can actually get away with much higher government debt levels, providing the consumer and the businesses have relatively healthy balance sheets. But today we have debt across every strata of society, and in terms of demographics, it's young people with student debt, it's middle-aged people, it's old people, it's everywhere, and then it's the companies as well. So when you aggregate all that debt, it's just absolutely huge, and it's never been seen before in history, the scale of this debt, So, and we used to talk about it in the global debt crisis in 2008 to 2012. And we started talking about 2011, 2012, how they were kicking the can down the road, and they did do that quite successfully, actually, more successfully than many of us thought they would, and they proved themselves to be much more capable than we thought they would. But ultimately, they didn't address the root cause of the problem, which is too much debt, particularly in the financial system. And now the debt is across the system, still in the financial system, but now it's even on the government balance sheets as well, So it's everybody is financially impaired. Sorry, not everybody, but the vast majority of society and all the key actors in our economies are impaired from a debt point of view, So that creates very significant risks, and it suggests they are going to, they've already said this, they are going to, try and print their way out of this, but they don't. They just go on the keyboard now, and they create trillions and trillions and trillions of euros, dollars, and pounds. And this is the fundamentals and the fundamental reason that gold and silver will do very well in the coming years is that the currencies, the fiat currencies, are going to be devalued. It's not so much that gold and silver are going up in price; it's that these currencies are going to lose value via our versus finite assets.
Right. So, Mark, do you see let's say the last month here, the strength in gold as a sign of the tide turning for demand and attitude towards the metals?
I think so. I mean, it's a long time coming, and I have been surprised how long it's taken for gold and particularly silver to recover from, I suppose, the bear market that we saw from the record nominal highs in 2012. So, given that the risks are in the world, I did think that they would, we should have record highs or record nominal highs at the very least, I would think at this stage. But I suppose that's, the manipulation is a factor, there's no doubt about that, but it's also a factor that we've had massive risk on, obviously, and you have stock markets, particularly in the US, and the tech sector is very sexy. So you have the FANG stocks and these tech stocks at all-time record highs, and a huge amount of money has gone in there. When you look at the market caps of these companies, it's just astronomical. These companies are valued at valuations never seen before in history. So the sentiment has been one of, I would say, almost extreme greed that you're seeing in the stock market, and meanwhile, the sentiment towards gold and silver has been tepid at at best, But that is, as you alluded to, it's beginning to change, but because of the risks, and very significant risks are out there, but also because the price movement, basically both gold and silver look very good from a technical point of view, and all sorts of different technical measurements in terms of the experts who look at the charts and look at moving averages and Bollinger Bands and all the rest of it. They both look very well, particularly gold, and I think silver will look very well as well, and should move very fast when it does move up, So it's been a long. Sorry, one other factor is that a lot of money that traditionally would go into silver in particular, but also gold, has actually gone into Bitcoin and into the cryptocurrency as well. So I think that has created quite a bit of demand destruction. Because a lot of the money that went in there is money that would have been people who are concerned about government debt, fiat currencies, banks. They would have bought gold and silver traditionally, and now they've been buying cryptos and Bitcoin and non-fungible tokens, and so that's that. And these are become huge markets now, huge capitalizations, if that's the right word for them. So I think that has actually siphoned away quite a bit of demand from the precious metals, and it's also people who are sort of more libertarians and free markets. Those people would have tended to have bought gold and silver, but a lot of them have migrated, and the new buyers of gold and silver, I think, are quite tin on the ground. It tends to be an older generation at this moment in time, and indeed, family offices and high net worth and central banks themselves are obviously the biggest buyers in the gold market. So I think they're the primary factors why gold and silver haven't hit record highs just yet.
Mm-hmm. So considering, that we've seen these moves, let's say by the Canadian government, where people's bank accounts and even crypto can be seized, doesn't this make a stronger case for owning physical gold and silver?
It does, yeah. And it's something I've written about for many, many years, is the risks posed from, I suppose, the cashless society, and in the legislation in most countries of the world, as driven by central banks, they have the bail-in legislation whereby they can actually confiscate the assets, the deposits of people and companies if the banks get into difficulty. And if that wasn't a frightening enough a vista, you just alluded to, our great leaders, including the so-called liberal Trudeau in Canada, in a so-called liberal democracy, threatening to freeze people's bank accounts. People who are, hardworking, decent people who are peacefully protesting are now going to be potentially have their assets frozen. So that's absolutely unprecedented. I don't think it's been seen in a liberal democracy and in modern history. It would have been considered outrageous. It's something you'd expect to see in Venezuela or North Korea, but to see this happening in Canada, and I think potentially if it's seen in Canada, the playbook is there. I wouldn't be surprised if we see it in Australia, potentially the UK and European countries in the coming months and years. So yeah, the cashless society, the risk that there is in banks, the risk coming from, I suppose lockdowns have shown it very, very clearly. It's not COVID that has done this; it's the response to COVID has been very, very authoritarian. They've shut down the SMEs, the small and medium enterprises. Sorry, they haven't shut down all of them, but they shut down a lot of them and put a lot of them out of business. And business is about, you need consistent revenues and incomes and profits, and they can't just, especially small medium enterprises, you can't just turn them off and turn them back on again. There's customers, it's their habits, it's goodwill, it's relationships, and if you shut down businesses for weeks and months on end, it's very, very damaging to these small medium enterprises. So they've shown their hand that they basically don't really care about small businesses and even medium-sized enterprises of 10, 20, 50 people. They care about the giant monopolies and the corporatocracies and the Amazons of this world and the Microsofts of this world and the Googles of this world and the big farmers of this world, who are doing very well indeed at the expense of the rest of the economy. So yeah, we have to think about becoming sovereign, becoming independent, and precious metals are one of the best ways to do that. Taking delivery of gold and silver coins and bars. If you feel secure enough in your own home, by all means, you should do that with some of your investments and your savings, some of your net worth. And then for larger amounts, it makes sense for people to have some in a different jurisdiction, because we all have geopolitical risk in our own countries now. So it's nice to have some of your nest egg, some of your savings in a different jurisdiction. And having seen what's happened in the world in recent months and years, I do think, I strongly believe that Switzerland remains the premier safe haven in the world. Switzerland has had some issues. They haven't been absolutely without their own lockdowns, and their response has not been ideal, shall we say, and not what many of us had expected from Switzerland. But it has been less strict, shall we say, less draconian than most nations in the world. And they do have the sort of direct democracy movements. They have the cantons. The federal government is a lot less powerful, actually, than many nations in the world. And I do think Switzerland will continue to be probably one of the best places for people to own precious metals. And then you have that liquidity as well. So yeah, no, I mean, this latest move by Trudeau, and I think we will see more of that in other countries, highlights the importance of, yeah, I mean, already your savings are being massively devalued through inflation. You're not getting any yield. So now you have all the risk of deposit bail-ins, deposit confiscation, loss of value through inflation. And now you have the risk, if you say something against your government, maybe you criticize the government or you criticize the central banks for their management of the economy, and maybe you criticize the government for allowing inflation to get out of control. Potentially you could have your bank account shut down. Your company's bank accounts could be shut down because you criticize the government. I mean, this is just absolutely unheard of and unprecedented. And if people think this is in any way okay in a liberal democracy, they really need to start, thinking about things a little bit more clearly, because it poses a real threat to everybody. We all have to. This is the whole concept of equality, for all, and liberty and fraternity, and justice for all, and not just for the elites or for the banks or for the politicians. It's for every single member of our society, whether they're black, white, Muslim, Christian, male, female, homosexual, heterosexual, LGBTQ2, MNXOP. It doesn't matter. We all need to have equality in front of the law, and we're all innocent until proven guilty. And you cannot have any government allowing banks to freeze people's bank accounts. It's absolutely outrageous and disgusting. So, and it does speak to why people need to, have less money in banks. I wouldn't say take all the money, you need to have some of your savings in banks, obviously, for day to day, but you wouldn't want to have too much money in banks in this day and age, unfortunately. And that means, and people, what they've done will potentially create a run on the bank systems, on the deposits, because people will get nervous, so it's very counterproductive what they've done,
So, Mark, we've recently seen short exposure, especially for silver, but also gold, come down significantly. Could this also be a sign of attitudes changing?
Yeah, I think so. Yeah, I think even the traders on the COMEX and the people who are trading in the futures market see the writing on the wall. And yeah, I tweeted an interesting chart the other day. I don't know who it was from, but it was very, very good, and it showed the positions. And as you said, they have quite drastically reduced the short positions. And the last time this was seen, a few years ago, I think it was roughly 2 years ago, maybe 2.5 years ago, when we saw the big move up around the start, actually, of the lockdowns, and the response to the so-called pandemic. So yeah, I think, yeah, even the traders and the bullion banks and the hedge funds on Wall Street see the writing on the wall. And they've reduced the short positions and they're going long, So I think, yeah, that's another reason. I mean, the technicals are very, very strong, as alluded to, as are the fundamentals for both gold and silver, and particularly silver. Yeah.
the last time we had you on, you were talking about the possibility of $150 silver mark. So do you still have that as a target?
I do. Yeah. And it hasn't come to pass. I don't want to sound like a broken record, but talk about manipulation, but it should be at that level genuinely, and given what we've seen in recent months and years, it should. That's me actually being conservative. I think it should actually be potentially higher, and it could easily go 200, 250. But people shouldn't, when I use figures like that, that could be a blow off top potentially. It depends. I mean, if we get massive currency devaluations and potentially hyperinflation in a worst case scenario, then 150 will be a low price for silver, obviously. But people shouldn't be trading or indeed buying physical silver based on price predictions of me or anybody else. It is quite sexy and people love big round numbers, whether it be silver $50 or $100 or $150. So ultimately I don't know, but I do think that is a realistic figure, and not hugely outrageous either. I am being relatively conservative. There are analysts who believe that silver could go as high as gold prices, and to be a 1-to-1 ratio, and I don't think that's realistic. But they do. Some of them think that gold could easily go to 10,000, and then silver could easily go to a ratio of 10 to 15 to 1, which could put you at silver at $1,000 an ounce. Again, that's highly unlikely unless we get hyperinflation and massive currency devaluations, which is possible. So what people should be doing, rather than salivating about 10x or 7x or whatever big round number is sexy for them, what they should be doing is saying, right, what's my goal here? What am I trying to achieve with my precious metals holdings? What are the risks in the world? They're very real. How do I own them? How do I own them in the safest way? What's the right balance? And I think given the world of today, I think what people should be considering doing is potentially using their gold and silver holdings to buy land, to buy property that's, if there's value, materialize in the coming years, which I think it will. But I think it depends. I mean, it depends on each individual and where they want to live and how they want to live and all the rest. But from my point of view, I think land is still very, very cheap around most of the Western world, and I do think the opportunities in terms of food and water and energy are very significant, and therefore it makes sense for people at some stage to, when gold and silver outperform, potentially there's a play there whereby you reduce your allocations to precious metals and potentially buy land, because I do think that we all need to work on the food, energy, water, self-sufficiency, building communities as well. Because I don't know if we'll be able to depend on governments in terms of city councils and city municipalities, and unfortunately I hate to say it, but I think the quality of life in cities may not be what it has been the last 30, 40, 50 years. I hope to God I'm proved wrong on that, but I think to ensure a better quality of life for yourself and your family, you probably want to be out, not survivalist in your shack in the woods type of thing, all by yourself with your shotguns and your gold, but in communities with like-minded people, people who have skills, who want to work together, and build more resilient communities. I think that's what we're going to need in quite a big way in the coming months and years. I think there'll be huge opportunities in that space actually to build self-sufficient communities, and the technology is very interesting on the energy side as well, that we could become less dependent on these antiquated electrical grids that we have, and also I think it's going to be obviously very expensive to in terms of we see what's happening with natural gas and oil. So the transportation side of things is quite interesting as well. That you don't want to be dependent on a diesel or gas or petrol cars. So there is a movement towards electric cars, but at the same time, I don't think you want to be completely dependent on electric cars either. There are some issues there as well. So it's all about diversification, and so yeah, you need to be thinking about those issues in terms of your goals, where you want to be, what you want to achieve, and then look at the precious metals as a tool in order for you to do that. And I do believe that everybody should always have a core position in precious metals as well, whereby you could actually be overweight, and I think you should be overweight precious metals in the short to medium term because they're so undervalued, particularly silver, and then rebalance, take profits along the way. If silver hits $45 or $90 rents, maybe take a small bit of profits there, and rebalance into gold or into platinum or into other commodities, or you start putting it aside whereby you can buy the land or buy the house or build that community that you want to build. So so I think rather than thinking about the price, always be thinking about the how you own it, and then what the exit strategy is in terms of what are you using it for ultimately.
Mm-hmm. Yeah, as you're mentioning, let's say $10,000 gold or $1,000 silver, it kind of makes me think that at that point you're not really measuring the value of your metal in dollars anymore, right?
No, exactly. I know you're thinking more in terms of ounces and what ounces can buy. And I do think there'll be opportunities to, I think whether it be buying land or buying property, if you are an owner of gold coins or gold bars or silver coins or silver bars, either in your possession or in very safe vaults, say in Zurich and Switzerland, I think the people who you want to buy assets from will be very interested in talking to you, because they probably won't want to take the devaluing Canadian dollars or US dollars or euros from a risky bank. I think they'll be much more happy to say, oh, you have 100 ounces of gold in the vault in Zurich. Okay, I'll open up an account in the same vault in Zurich and we can move down. So I think they will become, we won't be seeing it as either a speculation or investment. We won't be looking at purely in terms of the price we bought it at and the price we sold it at. I think potentially we'll be looking at as a real store of value and as a means of exchange and as a form of actual currency and money, And I think that's where we're going to ultimately. And I think that's when these metals will show their true value, both in terms of price but also in terms of utility.
So, Mark, when we think about, let's say, the risk of these hyperinflating currencies, we've recently seen that the Central Bank of Ireland has increased its gold reserves as well. So is there reasoning for this currency risk, do you think?
Yeah, it is the short answer. And that's why the other central banks around the world are buying it. They haven't expressly said that because they're never going to allude to the risk of hyperinflation, and they would always discount it. So in their words, they've said it's because of the risk of inflation. So and in effect, inflation is a form of currency devaluation, so because the purchasing power of the currencies are lessening all the time. And I think inflation is even much higher than the governments are admitting to. We know that they have been manipulating the inflation statistics for years with all sorts of chicanery in terms of the methodology of how they calculate the inflation. And they've various hedonic adjustments and all the rest of it, and then they strip out key components, X food and energy as an example in the US, So and then we have shrinkflation as well, whereby I don't know if I said this the last interview, but it's in Ireland and in the UK. I'll give the example of Ireland because I know in terms of euros. So we used to buy a 300 gram bag of spinach, and that would be €3. And now that same bag of spinach, it's still €3. I'm sorry, it's not 300 grams. It's still €3, but it's 100 grams of spinach. So there's a third less spinach in the bag. So that's a 200% increase in the price of spinach, Mm-hmm. But that's not been put into the inflation statistics, So we're beginning to see that. We used to see this with Mars bars and confectionery and chocolate bars and all the rest, and we didn't mind because the bars are getting smaller, and we don't mind that because people are a little bit more health conscious. Some people are anyway, and so they didn't mind that they were paying the same price or more, and the chocolate treats were getting smaller. But now we're seeing it in the food, and in healthy food, and fruit and veg, in meat, that the quantity is going down, but the price stays the same. So that's called shrinkflation, and that's a real phenomenon that we've seen very significantly in recent years, and that's not feeding through into the actual inflation statistics, So the central banks see this, they know this, and so that's one of the reasons why the Central Bank of Ireland has been buying gold, and other central banks. Different central banks may have slightly different motivations. I think the People's Bank of China, their motivation is because they want to position China and the yuan as the reserve currency of the world. So they would have quite a different motivation than, say, the Irish Central Bank. And the Irish Central Bank, there may be something there, whereby potentially there's a realization that the euro itself is at risk, and obviously Ireland uses the euro, and we're part of the monetary union, and the ECB is our central bank. But there may be a realization that if, for whatever reason, the euro was to come under significant pressure, and indeed, if the European Monetary Union actually fell apart, then having some gold reserves might help Ireland in terms of potentially being forced to move to a punt. I don't think the elites in Ireland, and including the elite central banker who was basically a New Zealand central banker who was parachuted into Ireland, I don't think he has obviously any intentions of taking Ireland out of the European Monetary Union. But the Germans plan for everything, and the Germans realize that, if Italy goes kaboom, or Greece goes kaboom, or, even France's issues with, so if some European monetary union member decides to leave the euro, which is quite possible, then the Germans have a plan B in terms of reverting to either a core euro area, or indeed potentially going back to national currencies, So the bottom line is, in Ireland, I know unfortunately the central bank reserves, they've risen very sharply, but from a very, very low base. So I would encourage everybody to become their own central bank, because the central banks, they're not doing it for the good of the people, shall we say. Although, I suppose if they did go back to some form of quasi gold standard because they had the actual gold reserves to back the currency, then you would have to respect that, But unfortunately, I don't think that's the motivation of the Western central banks, anyway, whatever about the Chinese.
Mm-hmm. Well, I think becoming your own central bank is sage advice there, Mark, and I appreciate all your time and your perspective today. Why don't you share with us where we can find more from you?
Yeah, so I've recently founded healthwealthgold.com, which is basically a mentoring, consulting, ambassador business. I'm working with some of the safest counterparties in the bullion industry, including Helveticor in Switzerland and Pro Aurum in Switzerland. So my website is healthwealthgold.com, and I put up various updates there in terms of different media, and you'll also get me on LinkedIn. I have quite a big profile on LinkedIn and on Twitter as well. And I hope to be doing a bit more in terms of YouTube and various Telegram and other censorship-resistant platforms in the coming months and years. We're going to be looking at that as well. So that's where people will get me, and feel free to contact me anytime, and we can have a conversation.
Absolutely. And of course, on Twitter, you're at Mark T. O'Byrne. Mark, thanks so much for your time today.
Thank you, Tom. Great being on with you again.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.